Hey guys, it's Stan here. Today we're going to talk about relationships. Relationships between balance sheet, profit and loss, and cash flow, which are called together the financial statements. In this video, you will learn how to build each of the statements, and afterwards we're going to link them together to see how they interact. And at the end of the video, we will analyze the performance of our example company here. Let's stay tuned and let's start with the balance sheet. Imagine the balance sheet as a picture which is taken once a year at the end of the year. On this picture you will see two sides which are very important. First of all, assets, and on the other side, liabilities. Assets are what the company owns, and liability is what the company owes to someone. Let's jump into each and look at the different categories we have inside. Let's start with our assets. We have 5 categories of assets. Again, assets are what a company owns. So what do we have here? We have a first category, cash. Obviously everything which is on the bank account of a company belongs to the company, which is cash. So first is pretty simple. Second one, accounts receivables. This is basically what the client owes to my company. Let's say if I produce these fancy glass bottles here, I have agreed with my biggest client, for example, that I'm gonna ship my bottles, so I'm gonna sell them to him in December and he's gonna pay me in January, which means basically I sold my bottles in December and he's gonna pay me in January. So at the end of the year here, I have some accounts receivables because he owes me for what I have sold him. Inventory, to satisfy future demand and be able to ship every time I can. I have produced more bottles that I have sold. So at the end of the year, actually, in my inventory, I'm gonna have some bottles that I'm gonna sell hopefully very soon. Then I have PPE, which is called property, plants and equipment. To produce these bottles, I need a factory, I need space, and I need some equipment and some tools. So obviously property, plants and equipment, very important if you want to mass produce physical goods. A last category, intangible assets. So non-tangible assets, stuff you cannot touch. That, for example, is intellectual property, algorithms and all these kind of things, and the brand value. To give you an example here, you have what is called asset-heavy companies like Ford, who produces cars. They're gonna need a lot of property, plants and equipment because obviously to produce cars you need a factory, you need a lot of space, you need machines and these kind of things. Against it or versus it comes asset-light companies like Uber. What does Uber need? They don't need PPE, they don't need a lot of machines, a lot of space and stuff like that. They need people who gonna program their app so they can connect drivers with customers. That's all they do. So that's why it's an asset-light company, because they have a lot of intangible assets, like their brand value. For example, Uber is roughly valued at $6 billion right now. So they do not have a lot of production capabilities here. Asset heavy, asset light, the difference. And with this chapter we are closing the assets and are now moving to the liabilities. What are liabilities? Again, it's what the company owes to someone. To whom? Well, let's find out. We have 4 categories in the liabilities, starting with accounts payables. What are accounts payables? Well, it's the supplier debt. Let's take the example again. To mass produce these bottles, I need some glass and some rubber here for my business. So I found a supplier in Asia, and I have decided we have agreed together that I'm gonna pay him a month later once I have received the raw materials. In this case, for example, I have received the raw materials in December. End of December, picture was taken, and I pay him in January, which is why I have a category accounts payables. I owe him money at the end of the month, or end of the year in this case. Second category, financial debt. That's probably something every American know. Financial debt is debt where you have to pay interests on. In this case, for example, I bought a new machine, which means I have a loan at the bank that I'm gonna pay back in the future with some interest. Next category, equity. Equity is let's say I have an investor and he's putting money in my business, so he's gonna increase his equity in my business. Why is he putting money in my business? Well, very simple, he's investing in my business, so he's expecting a return on his investment. That's why I owe him something in the future. Retained earnings are the profits of last year which remain in the company, which means they are not distributed. Okay, now look at the numbers we have in our balance sheet for 2018 and for 2019 when the pictures were taken. So cash going up from 80 to 120. Accounts receivables also going up, which means more clients end of 19 owe us than they did in 2018. Then inventory going significantly down, which means we managed better end of 19 our inventory, so we sold technically everything we had in 2018 and were able to manage our inventory better at the end of the year. Then property, plants and equipment going up by 10, and I told you there are two elements happening here actually. First of all, we bought a new machine, so we invested to be more productive in the future. So our new machine cost 15, so that's an increase of 15. And we also had a loss of value of the old machine of -5, so plus 15 new machine, amortization of the old machine -5, sum plus 10, which is the increase here. And then we had a decrease in the intangible asset, a depreciation here. Then when we look at the liability side, accounts payables going up, which means that we had more debt to our suppliers at the end of 19 than we had at end of 18. Financial debt going down because we paid back some financial loans here in this case. Equity going up because our investor has trust in us and put some fresh money into our business because he trusts our brand and our products. And retained earnings roughly the same as last year. Last point, which is very important about the balance sheet, is always make sure that your assets for 1 year equal your liabilities, so 224, same for 2019 obviously. So now let's jump into the second financial statement, which is the profit and loss. So what is the goal of a profit and loss statement? Calculate a profit or a loss. That's the name of the game here. So you start with your revenues and you're gonna withdraw a lot of operating costs and other costs afterwards, and at the end of the day you will either have a positive number at the end, it's gonna be a profit, or negative, which is gonna be a loss. Now that we have our revenues, we will retrieve our operating costs. So we have 3 categories of operating costs. Usually we have personnel costs, we have material costs, and we have other operating costs. Personnel cost, I think it's pretty straightforward. It's basically the payroll cost. So then a second category, material. As we already discussed, to produce these kind of bottles you need some glass and some rubber, which is gonna be your material costs. Other operating costs is basically all the rest which is operating. For example, the rent, for example, for your factory, the insurance of the business, office supplies, and all these kind of things. I can give you an extensive list of that. And all this leads to operating profit, which is also called EBITDA. And EBITDA is kind of the fancy name of operating profits. So for what does it stand for? It's earnings before interest, taxes, depreciation, and amortization. And this will make a lot of sense when we go down to the end of a profit and loss statement. So we're going to retrieve depreciation as well as amortization. Both have a similar logic. It's basically the loss of value of an asset, but the little difference between both is actually depreciation is for intangible assets and the amortization always refers to property, plants and equipment. Let's say a machine here. As you remember here, we have an increase of property, plants and equipment of 10, but that's plus 15 for the new machine and minus 5 amortization because the old machine lost some value. All this leads to EBIT, which is earnings before interests and taxes. Now, as you can probably imagine, there is still an I and a T. So we're gonna retrieve interests and we're gonna retrieve taxes. And look what we have now. We only the E stands, so the earnings, which basically means we have net earnings here. You can call it net earnings, net profits, net income, it's all the same. So what have we done here? We are starting with revenues, then we retrieve the operating costs, leading to an operating profit, also called EBITDA. Then we get rid of the loss of value, which is depreciation and amortization, leading to earnings before interest and taxes. Then we retrieve interests and taxes, which leads to our net earnings. So what does it mean? With a revenue of 200, we were able to generate an operating profit of 40. After loss of value, we still have 30, and then we pay our then we have interest and tax costs, which are out, and we have a net earnings of 20 at the end of the day. Now let's look at the third financial statement we have on our list today, which is cash flow. As you can see, we have a direct cash flow and an indirect cash flow, and right now I'm going to explain you the difference, and we're going to fill it the same way we have done it with the two other financial statements, and then we're going to link them all together. Direct cash flow is actually very simple to understand. Imagine your bank account. On your bank account you're going to have one inflow, which is going to be usually your salary, and then you're going to have a lot of outflows such as your rent or your mortgage, your food, your insurance and all that stuff. When you look at a bank statement of yourself, you're going to have starting balance, one inflow, a lot of outflows and an end balance. Well, guess what? That's exactly the same in the direct cash flow for a company. Direct cash flow starts with an opening balance or starting balance. Then, the same way in our P&L we had our revenues, in the direct cash flow we're gonna have our cash ins. What are cash ins? Well, each time you make a sale, you create some revenue, and at some point when your client pays you, it's gonna turn into a cash in. Next on the list is personnel cash outs. To explain, you will understand in a few minutes why this is cost and this is cash out and the difference between those two. So stay tuned for a little bit. Afterwards we have material paid, then interest paid, taxes paid, and other operating cash outs. And all this, same logic as in the P&L where you have revenues minus a lot of operating costs. Here you have cash ins and then a lot of operating cash outs, which gonna lead to an operating cash flow. Okay, now it's time to add some numbers into our direct cash flow. So starting cash for 2019 is the end cash of 2018. When we look at our balance sheet, cash end of December 2018 was 80. So our starting cash in 2019 is 80. Then we have our cash ins, which are in this case 180 positive. And then we have a lot of negative numbers. So personnel paid was 80, material paid 19, interest paid 2, tax paid minus 8, and other operating cash outs in my model minus 22, leading to an operating cash flow of plus 49. Okay, so now you might think, but hold on. Operating cash flow and EBITDA, which means operating profit, they look kind of similar how they are calculated. So what's the big difference here? Why do we have a P&L and a cash flow? Very simple but very important answer here. In the P&L you go revenue minus a lot of costs, and in the cash flow you go cash ins minus a lot of cash outs. So you see there is a big difference between revenue and cash in, as well as cash out and costs. Okay, that's very important to understand. And here we see it in the model. Our revenues are 200, but our cash ins are only 180 because some of our clients, and let's take the example again of my famous glass bottle here, they have not paid me yet. I already shipped the bottle, but I'm still expecting a payment. That's why I have a gap between my revenues at the end of the year, 200, and my cash ins 180. So as you can see, there is a gap, and that's also the gap you will find in your accounts receivables. You see, it's going up by 20, so you have a gap here between your revenue and your cash ins. Then on the other side, same game, personal costs and personal cash outs here and in most companies are the same. Why? Because think about it, your payroll, your employee who works for you, you're gonna pay him the same month as you have the costs, right? He's not gonna work for you in November and you're gonna pay him January. That's never gonna happen. That's why personal costs and personal cash outs usually are the same. Material costs, as you can see, between material costs and material paid, we have a pretty big gap. Why? Because I have agreed with my supplier, who supplied me with the rubber and the glass, that I'm gonna pay him later. Okay, so that's why, because I manage my cash pretty well as well. So I have material cost of 50, but a material paid only 19. So now you understand the gap. And the gap you will always always see it in my accounts payables as well. You have accounts payables because you have a supplier debt, which means actually that your material costs will at some point go into your cash flow. But right now you can see that the difference between 50 and 19 is quite significant because I have agreed with my supplier that I'm gonna pay him later. So I'm delaying the payment. What else do we have? Well, we have another big difference here is that in the operating cash flow, interests and taxes are included, and in my EBITDA, as you can see, it is not included. That's just basically how it works. You know, there is no proper logic to it in the P&L. It's just in the P&L you are saying that interests and taxes are not part of the operating profits. But in the cash flow, you are saying, okay, but to generate some operating cash flow, I needed some loans, I need to pay the government and stuff like that. That's why I put the interest paid and the tax paid inside here. Now let's move on with the cash flow to the next section, which is investing cash flow. As we have discussed earlier, I have invested in a new machine. I invested 15, if you remember. That's what my number is going up by 10. 5 is amortization. Plus 15 is the new machine I have bought. And since I have bought it for 15, I already paid for it in 2019. That's why obviously I have a cash out of 15 here. Okay? Okay, now that we know what operating cash flow is and what investing cash flow is, we're gonna talk about free cash flow. Free cash flow is one of the most important metrics in all the financial statements here. So operating cash flow minus investing cash flow leads to what is called free cash flow. And free cash flow, it's operating minus investing. So this is plus 34 in this case. So why is it so important and what does it mean? Well, it means that the company generated 34 of cash, right? This number here, the free cash flow, tells you, did the company generate or burn cash? In this case it's positive, so it is generating cash. If it was, let's say, minus 34, for example, number, it would have meant that the company is burning cash, which is generally a bad sign. So in our case here, we are generating 34 of cash, which is a good sign. As you can see, my business generates 49 of operating cash flow, and I have invested in the future with my new machine 15, so cash generation 34. Now let's move on to the last part, which is called financial cash flow. The financial cash flow tracks financial in and financial outflows. So let's get to our example. What happened here in this company? Well, first of all, as you can see, the equity is going up. So we had a capital or an equity injection from our investor who believes in us, in our brand, and in our product. So we have an equity injection plus 28. You might ask, well, hold on, why is it positive? Well, think as a cash flow. What happens when you get money from an investor? Obviously, you owe him some money in the future, but when you get that money from your investor, obviously it has a positive effect on your cash flow in the short term. Then afterwards, what happened? Look at the financial debt. Financial debt is going down significantly, which means we have paid back some loan to the bank. So we have a reimbursement 14. This time it is negative because obviously when I'm reimbursing some debt, it has a negative effect on my cash flow. And the third effect that you cannot directly see here is last year the company performed well and generated some profits, and they have decided to pay some dividends to the shareholders. So we also have dividends paid, 8 in this case. When we sum up these three financial in and outflows, we have a financial cash flow plus 6. Wrong color. Yes, here we go. And then now we have our 3 blocks. We have operating cash flow, investing cash flow. These two combined lead to our free cash flow. And the third block is the financial cash flow, which we all just discussed. Now, when we look at the entire thing, what is missing? We need an end balance and we need a variation. So you have cash end of year. It's gonna be 120. And it's basically starting cash plus free cash plus financial cash. So it's 80 plus 34 plus 6 equals to 120. And now we can calculate our cash variation, 40. Why 40 plus 40? Why 40? Because, look, very simple. Cash end of year 120, starting cash 80, 120 minus 80 leads to plus 40. Very simple. And here we go, we have our direct cash flow. Now I would like to point out something I discussed earlier in this video. It was the retained earnings. So why do we have a retained earnings of 12 and what does it mean? Look at what happened this year. We have net earnings of 20 and we paid out dividends of 8. And earlier in this video I was saying that retained earnings are profits that stay in the company and have not been distributed. Now look, that's exactly what happened. We have a net earnings or net profits of 20. And what did we distribute out of this profit? Well, dividends have been paid to the shareholders, 8. So when you say 20 minus 8, that's your retained earnings of 12 here. Yeah, I wanted to mention a last thing about the direct cash flow because I've seen this error many times and it's really a beginner's mistake you should definitely avoid. A lot of people think they're looking at the cash variation and see, oh, very simple, the company generated 40 of cash. That's totally wrong. Remember what I told you before? The cash generation or cash burn of a company is here. It's the free cash flow which gonna tell you, okay, this company generated 34 of cash in this case. Negative, it would have burned cash, okay? The cash variation only tells you what happened with the cash. We had a starting cash of 80 and a cash end of year of 120, so my cash went up. by 40. But it's not meaning that I have generated 40 because I only generated 34. Inside the cash variation you also have all kinds of inflows, for example capital injection, reimbursements of debt and all these kind of things which are not calculated in the generation or in the burn of cash. So that's very important. Keep that in mind. Cash variation is not cash generation. Okay, now let's talk about the indirect cash flow. So what is the indirect cash flow? Indirect cash flow will answer usually investors' questions or CEO or CFO's questions, who will always ask the same question. I have an operating profit of 40 and I only have a free cash flow or a cash generation of 34, so what the hell happened between my 40 and my 34? That's usually the question you get either from investors or from your boss. So the indirect cash flow is what's gonna help you to bridge, in this case EBITDA to free cash. So the indirect cash flow is the one you will also see in financial reports usually, because the direct cash flow is something that is kept kind of secret inside the company because it's more useful for inside use than for the investor. Because the investor wants to know, okay, I have an operating profit of 40, I have 34 free cash, what happened in between? So in the indirect cash flow we are going from EBITDA, free cash flow. We already know that our EBITDA is 40 and that our free cash flow, so our cash generation, is 34. So what happened in between and why do we have a gap? Well, let's look at how both numbers are calculated. First of all, what do we notice? That in our free cash flow there is investing cash flow. Look at our P&L. As you can see, there is nothing referring to invest, right? It's not included, it's not even in the P&L. So there is definitely this criteria you have to put into consideration here. So you have investing cash flow that you have to retrieve from your EBITDA to bridge it to your free cash flow. So that's minus 15. What else is different? That's something we already pointed out before. Look at where interest and taxes are in my P&L. They are way below EBITDA, which means they're not included in my operating profits. Here in my free cash flow, you can see that interest and taxes are included, which means you have a gap between both. So you have to retrieve them from your EBITDA to bridge it to your free cash flow. Minus 2 and minus 8. Okay. And the last thing I would like to discuss, I will make an entire video about it, which is called the working capital. That's kind of a complicated topic, which is super important and that you have to understand. So what I would suggest is subscribe to this channel, because the next video will be about working capital and why it is so important. I will give you a brief answer to it, and we're going to quickly calculate it to finalize our model here. But working capital is definitely something super important you have to keep in mind. The last point is working capital change. What is working capital? We have kind of talked about it a little bit in the past here. Remember when we were talking about the difference between P&L and cash flow? As you can see, my revenues are not directly translated into cash-ins because my client is paying me later. And on the cost side, I have managed to pay my suppliers later. As you can see with the materials and other operating costs, that material costs were 50, but material paid only 19, which means I'm delaying my supplier payment as agreed with him. What does it mean? Well, you can see it in two positions. First of all, my accounts receivables going up because my client is not paying me right now. He's paying me later. That's why my accounts receivables are going up. And on the other side, on the cost side, as you can see, my accounts payables are going up because I kind of managed my cash pretty well, and I have decided or agreed with my supplier that I'm gonna pay him later. there are a few positions inside, and again, you will see it's a bit complicated, so I don't want to overstress you with too much stuff. I'm gonna make a special video next week to explain every detail of it and why it's so important. But here again, we're gonna quickly calculate it to finalize our model. So you have 4 positions going into the working capital change here, which are accounts receivables, accounts payables, inventory, as well as financial debt. We are talking about the working capital change, which means we're gonna analyze one year versus the other year. So first of all, let's look at the balance sheet. What happened in the balance sheet? In the balance sheet, my accounts receivables are going up by 20. So the balance sheet effect is plus 20. On the other side, accounts payables are going up, and they're going up by 15, right? What's going on with my inventory? My inventory is going down drastically. What does it mean? Actually, I had a lot of inventory last year. I piled up a lot of products that I was able to sell. So I was able to decrease my inventory, which is a good thing because inventory always costs you money. Inventory going significantly down by 39, okay? And the last element of my working capital is financial debt. What's going on with my financial debt? Financial debt is going down because I was able to pay back a loan in this case. Financial debt going down by 14, okay? Now look, these are balance sheet effects, right? Now we have to think, don't forget what we are trying to do here. We are bridging a P&L metric to a cash flow metric, okay? So our idea here, we need to know what happens cash-wise. Now we know what happened in the balance sheet. Now we need to know what is the effect on our cash flow. So think about it. What happened here? When we look at the cash flow, accounts receivables going up means clients did not pay me, which is bad for my cash flow. So negative effect here, okay? Plus 20 in the balance sheet, effect minus 20 in the cash flow. Accounts payables up in the balance sheet, that's good for my cash, so that's a positive cash. Why? Because I have decided, or I have delayed some payments, some supplier payments, which is good for my cash because I keep it in my pocket right now, okay? Then inventory going down, that's as well a positive effect because I was able to sell all my inventory. Which last part, financial debt. Well, I paid back some loan, which is a good thing, but for my cash, it's bad. Okay, I paid back some loan. Now, if we want to calculate the working capital change, we just have to sum up our cash positions here. Minus 20, plus 15, plus 39, minus 14, the capital change of plus 19. Okay? So plus 19 means actually I have a positive working capital, which is a good thing. Again, I'm gonna explain it very well in the next video. It would be too long in this video, but keep in mind here how it's calculated. It's plus 19. I can put it in my model here, and you will see that now I have bridged my EBITDA to my free cash flow, right? I'm saying, okay, I had an operating profit of 40, minus investing cash flow, minus interest, minus taxes, and plus this working capital change leads to 34. So I was able to explain what happened between my operating profits of 40 and my cash generation of 34. Okay, now we're gonna sum up everything we have done so far. So here, that's the PDF you can download in the description below. Very simple, that's exactly what we have discussed so far. Balance sheet, profit and loss, the two cash flows, and the working capital calculation. And I have color-coded the numbers so you can easily follow them through the different financial statements. So here, cash end of 18 was 80 million in the assets in the balance sheet, which we also find in the direct cash flow as a starting cash for 2019. end cash 2019 was also the end cash in the cash flow. And the cash variation in the balance sheet is also what you find here in the cash variation in the cash flow. When you look at the accounts receivables and the inventory 2019 versus 2018, you will see that's exactly what we have taken here and here in our working capital calculation. The intangible assets have decreased by 5, which is also the depreciation we take here in our P&L. On the liability side, you see that our accounts payables went up by 15, which is also what we are finding here in our working capital calculation. The financial debt has been repaid by 14, which you will also find here in the reimbursement of financial debt in our financial cash flow. Owner's investment here, equity, been up by 28, which we'll also find here as an equity injection in our cash flow. EBITDA was 40, and that's also the starting point for our indirect cash flow. You see that interest and taxes from the P&L are also reflected here in interest paid and taxes paid in our cash flow. When we look at our investing cash flow, you will see that it's also in the bridge here, the minus 15, and that the free cash flow from the direct cash flow is also the end point in our indirect cash flow. Cash effect here of the working capital change plus 19 also goes in our bridge from EBITDA to free cash. So that's it for today. Make sure to subscribe and to like, and catch you in the next one. Peace.